Hi, everyone. Thank you so much for joining us for tonight's event. My name is Marissa Stahl, and I'm the president of the Young Alumni Council at USC. We're so excited for this workshop with American Pacific Mortgage. This is actually our second year doing this with them, and we always get amazing comments from people who find it very helpful and educational, and we're so excited to bring them back for another year. They have been a really valued partner with the Alumni Association for 3 years. They're located in Sacramento, but they help clients all over the country. So no matter where you're located, they are able to help you or give you a little bit more information if you are venturing into the home buying process. Before we get started, just want to give a little bit of background about the Young Alumni Council and the events that we put on throughout the year. Technically, to be considered a young alum in the Young Alumni Generational Group, it's any alumni who's aged 35 and under. One of the amazing things about the USC Alumni Association is that you don't have to apply, you don't have to pay any dues. Once you graduate from the university, you're automatically in the Alumni Association and available to attend any events or take any resources that the university provides to their alumni. So for the Young Alumni Council, we do a ton of events throughout the year that are social, professional, and just really trying to help you grow and stay educated in so many areas of your life. We'll do things on health and wellness, community service. We have a diversity, equity, and inclusion week coming up that is part of the Alumni Association as a whole. So definitely stay tuned and check us out on social media if you're interested in more programming from us or connecting with any of your fellow alums. If you are over 35, you're still more than welcome to join us at any of our events. You're technically in a different generational alumni group, but we'd be more than happy to have you. And the Alumni Association as a whole has so much to offer. There's so many groups and so much programming that's always going on. So I really encourage you to check out the Alumni Association website to find everything there. But without further ado, I will kick it off to Jason from American Pacific Mortgage, and he will get started. Thanks, guys.
All right. Thanks, Marissa. Good evening, everyone. It's great to be with you this evening. I think I'm in that 35 and older generational group, Marissa, so I can't slide into the young alumni group. But with that, I'm still really privileged to get a chance to speak with you guys this evening. We're in our third year of partnership with USC. This is a great partnership, and we really want to add value to our alumni base, especially our young alumni base. And I'm very fortunate where I get a chance to teach these workshops every couple of weeks to different audiences all across the West Coast. So as Marissa mentioned, we are based out of Sacramento. That's kind of our hub, but we service all over the West Coast for home ownership. So whether you're refinancing, which some of you may be thinking about that, but more often than not, you guys are probably thinking about your first opportunity towards home ownership. So that's really what this workshop is designed around this evening, is to kind of really talk more about home ownership and probably what is going to be one of the biggest investments you make in your lifetime in purchasing a future home. So let's jump into it. Just for some logistics here for this evening, we're going to have Q&A throughout tonight's discussion. So we're going to have kind of more of a discussion with you tonight. So you can use the Q&A function in Zoom. Ken Fleck, a part of our team here in the office, he's going to help you through some questions in the Q&A section. And so he'll stop me as we're kind of going through tonight's content, and we'll kind of tackle some of your topics. I did have a few questions that came in before we kicked off tonight, so I'll kind of go through those. So we have 3 questions that came in from the audience ahead of time, so we'll address those in a bit. But feel free to use the Q&A to reach out to Ken, and then we'll kind of go through that. At the end of tonight's conversation, we'll go and open it up for Q&A as well. So if you don't get your question answered or covered through our topics, we're more than happy to kind of circle back to that for you. Okay. So a little bit about me. Again, my name is Jason Maida. I'm the manager for American Pacific Mortgage, again, based out of Sacramento, but servicing the West Coast. And we get the opportunity again to share this information every couple of weeks over Zoom. We provide a wide array of programs, including conventional loans, FHA loans, VA, USDA, and I'm really specialized in more of the first-time buyer programs that are offered. So there's a program offered through Cal HFA, which is the California Housing Finance Agency. and it specializes in serving the low to moderate income households across California. So we're going to spend some time this evening talking a little bit about CalHFA and how it might be able to support you in assistance for both down payment and closing costs and purchasing a home. Okay, so let's go ahead and get started. Tonight's discussion, we're going to spend some time looking at the housing market in just a second. Lots going on with the housing market as it relates to just really lack of inventory out there, but really the competitiveness that's in the market today. We're also going to kind of look at, does buying make sense for us? You know, like I said earlier, this is probably the largest investment that you're going to make in your lifetime. So, you know, hats off to everyone on this call tonight that you're taking the time to do your due diligence and really understand what home ownership could mean for you. We're going to look at credit tonight. There's usually two things that hold people back from taking that next step into home ownership. It's either credit or it's just lack of resources for down payment. And so we'll spend some time looking at credit and some opportunities to learn a little bit more about how you can possibly improve credit or just optimize your credit. We're going to look at different loan programs, not just for first-time home buyers, but loan programs in general. We also have some specialized programs for medical professionals that we'll dive into as well. Look at qualifying income. Again, I mentioned down payment assistance. And then we'll wrap up tonight's discussion by looking at what a personal consultation could be for you. So if you really want to take the next steps in home ownership and learn about a little bit more about designing your own home ownership game plan, we'll kind of take you through that. And then finally, I'll walk you through our 6 steps of home buying. What does it look like to be pre-approved for a home all the way to getting your keys and taking that final step there? Okay, so that's tonight's discussion, and we'll jump in right now by kind of looking at the housing market. So that's probably one of the biggest questions we get is, what's going on in the market? Obviously, we're still in the midst of COVID and the pandemic, and thank goodness in California, the shelter in place has been lifted. So hopefully a lot of our communities will be in a better place here soon. But certainly in the housing market, ever since we kind of were in this pandemic environment, we've seen huge demand in the housing market. And unfortunately, we have high demand, but limited inventory. So what we are seeing across all communities in California, and it's not just California, it's even some of our neighboring states, is prices being pushed even higher. And there's such a competitive lift in the market right now because we just don't have the inventory to supply the amount of demand that's out there. So the short-term effect that we're seeing is that it's creating a very competitive market. So when a buyer is going out and looking at homes, it's not just 1 or 2 families that are also interested in that property. It's usually 15 to 20 other buyers that are also interested in that property. So what you're seeing happen right now, and we'll talk a little bit about this later tonight, is you're seeing some concern around appraised values of homes because demand has pushed up these prices of homes, but unfortunately, there's not enough data in the market to support some of these appraised values coming in sufficiently. So that's what we're kind of seeing in the short term. It's a high competitive market right now. And I think the other effect that we're seeing in the market right now is the location of employers is starting to look different. So you're having the option as an employee to work from home. And so many of our clients are looking at moving out of maybe higher cost of living areas, or maybe trying to find something that's better suited from a housing perspective because they don't have the commute that they once had. So that's obviously changing the dynamic in the housing market as well. Question? Yeah.
Do you recommend buying now while interest rates are low, or waiting for the seller's market?
The big question, which is, do you recommend buying homes right now with the interest rate environment the way it is? My answer to that is always it depends, because not everybody's in a position to be able to buy. So it depends on where you're at, and if it's part of kind of your short-term game plan. I think we're going to look at interest rates tonight and kind of show you the trend in interest rates of what we've seen. Certainly, lower interest rates means better purchasing power for you as a buyer. So if rates are at 4%, that same purchase price of $500,000 in the payment is going to look a lot different than at, say, 2.75 where rates are at today. So if it makes sense for you and you're in that financial position, it could be something that you want to consider. So, but certainly interest rates are sparking a lot of this high demand out that we're seeing in the marketplace. Long-term effects of kind of where the housing market is going, it's really unknown. The latest stimulus package just passed, and so we're still, as an economy, still trying to recover. And we don't know what that's going to look like when it comes to the longer term effects of the housing market. Unemployment rates are still in a really challenging position. We haven't seen anything when it comes to distressed sales at this point. So short sales, foreclosures, those haven't really kind of reared the ugly head yet. But it still remains to be seen what happens. As part as the CARES Act, there was some support for existing homeowners that were having challenges because of unemployment and they couldn't make their payments. So, hopefully that kind of helps support the housing market a bit. So we didn't see as much in the way of foreclosures and short sales in the short term, but we don't know what kind of the runway is going to look like that in the future, or the horizon looks like that in the future. Okay. And by the way, that question that Ken brought up, that was actually another question that came in earlier before tonight's discussion, which was, is this the right time to buy a house? So hopefully by the time when we go through tonight's discussion, you're going to get a good amount of information. It's going to help give you the resources and support to help start kind of formulate a decision for your own if it is the right time to go ahead and take the next steps in home ownership. So thinking about home ownership, we got to first start with, does buying make sense for us? Because really it's not for everyone. It does give you the ability to be able to control your expenses a bit more. No longer are you, worried about your landlord getting ready to increase the rent because now you're at lease renewal. So you're kind of controlling that housing budget a little bit more. So that creates a bit more stability for you. This is an asset that you're purchasing. So this isn't like running down to the auto mall and buying a car. So you do have potential growth in equity, which is part of that asset. There still remains some tax benefits with purchasing a home. No longer can you deduct property taxes, but you still can potentially deduct interest. So that's something also taken into consideration. And this is an asset. So this gives you the ability to pass along the asset to heirs of your estate. So a lot of cool things that come with home ownership. And when you compare renting versus home ownership, it's not necessarily an apples to apples comparison. So even though I'm paying $2,500 in rent, that doesn't necessarily equate to $2,500 in mortgage or household expense. So a great way to kind of draw that comparison is to use a calculator, which is called a rent versus buying calculator. So this is brought to us by Freddie Mac. And so as part of these workshops, we like to kind of dive into just a quick calculation so you can kind of see a side-by-side comparison of renting versus buying. So let me go ahead and jump into that really quick. Let me just back up for a second. Okay, let's just check to make sure we get on our screen there, Ken.
Yep.
Okay, cool. All right, so I'm just going to walk you guys through the calculation. Just as a quick side note, all of our material from tonight's discussion is going to be emailed back out to you. So you get this entire deck page. This has all the links that I'm going to share with you tonight. So you can feel free to go in and do your own calculation of rent versus buying when you have some free time. But I'll walk you through it here really quick and just take you through the data points so you can understand what goes into these calculations. So where you're going to start here is on the renting tab here, which is you're going to just input your monthly rent. So whatever that amount is, we're going to put in $2,500 for tonight's discussion. And then if you're renting, you probably have renter's insurance. So we're going to plug in $15 there in rental insurance. And then assuming I have some type of increase in rent, we're going to say 2% per year in rent. Okay. So at lease renewal, if my landlord increases my rent by 2%, that's what we're looking at there. Now, as purchase price of home, this is going to vary based upon where you're going to buy. So I think, depending on if most of us are in Southern California, whether that's LA County or Orange County, if we're up in Northern California, you can adjust that purchase price accordingly. We're going to put it at $500,000 right now, just for us to kind of walk through this exercise. Down payment, the minimum down payment on $500,000 is 3%. Okay, and this is a conventional loan that we're looking at. And then property taxes. We're going to estimate property taxes right around $6,000 a year. Homeowners insurance at $1,000 a year. And then we're going to go and plug in $2,000 for maintenance. So we want to add that line item for maintenance because obviously when we're owning, we're going to have to kind of figure out how we can repair things, and that's going to have a cost associated with it. So no longer are we going to be able to call a landlord and say, hey, gosh, I don't have any hot water. Now we're going to have to do that fix ourselves. And then in terms of loan information, we're going to put in a 30-year fixed mortgage. By the way, for first-time home buyers, if you decide to get financing in place, 99% of first-time buyers will be electing 30-year fixed mortgages. So, and we're going to talk about interest rates in just a minute, but most of us are going to be selecting 30-year fixed mortgages because that makes the most sense from a more of a conservative approach, but also just more predictable for you. So we don't have to worry about adjustments in interest rate, and they're consistent 30-year fixed payments. So for the full 30 years, you're going to have the same monthly payments. And then we're going to put interest rate in here. Now, interest rates, which we're going to look at in just a second, are a bit lower than 3%, but for this exercise, we're just going to leave 3 there for now. And then origination costs, which we put at $3,000, those are also known as closing costs. Closing costs when you purchase a home will usually be anywhere between 2 to 3% of your purchase price. Okay. Discount points, you may hear those terms when looking at interest rates. A discount point is something that you can pay as a consumer that helps you lower the cost of your interest rate. So if an interest rate is 2.75 and you elect to pay 1 point, for example, which is 1%, then you're looking to buy down your interest rate to, in this case, say 2.5%. And then the other settlement charges here, those are going to be part of your closing costs. Those would be things like title and escrow, which we'll talk about a little bit later in tonight's discussion. The other assumptions we're going to make is appreciation in our home. So let's assume it's going to go up maybe 3% per year. We're going to say that we're going to be in the house for 7 years. The cost of selling a home at 10%. When you are represented as a buyer in purchasing a home, you don't pay a cost to a realtor. So that's an important distinction that a lot of first-time buyers don't realize. When you have a realtor that represents you in your home purchase, their commissions are paid for by the seller or in the sale of their home. Now, when you sell your home the way we have it kind of set up with this calculation, when you sell your house in 7 years, you too will be paying those same selling costs, which we have at about 10%. That might be a little bit on the high side, but we rather kind of show this more of in a conservative approach, and then you can have a calculation that's going to be a little bit more realistic in the future here. So, and then you have your tax rate, and then we have the savings rate here. So if we take a look at our comparison now, so when I look at up here at the total cost, ultimately, if I decide to purchase at $500,000 versus renting at $2,500 a month, it's going to save me about $105,000 a year. I'm sorry, over 7 years. Now, how do we come up with that calculation? Well, the calculator is taking into consideration appreciation in your home at 3% per year. Obviously, rent going up at 2%, so that difference in there, plus the tax benefits that you're achieving. And so ultimately, at the end of 7 years, your net opportunity is about $105,000. Now, from a payment perspective, you can see you're going to be paying more out on the mortgage from a monthly payment perspective because you're going to be closer to $3,200 versus $2,500. But the opportunity over 7 years is going to be closer to that $100,000 mark. Okay. Now, if you're renting a room for $700 a month and now you're going to run out and buy a $500,000 house, the math is not going to be as favorable towards buying it. It would probably make more sense to continue renting. But if this is one of your goals in your financial plan, then you're going to have to kind of draw that comparison of, hey, I'm paying $500 now, but look at the opportunity that I have down the road here. Okay. I'll take a quick pause there because I know it's a lot of information with the calculator. Is there any questions I can help answer there, Ken?
Nope, I answered the ones that have come in so far.
Okay, cool. Okay, so, and just a quick check, I'm back on the Freddie Mac slide, where I was.
You're on, yeah.
Okay.
House pricing.
Okay, sweet. All right. Awesome. So again, we'll send you the deck page here so you guys will have the link to be able to go and do your own calculation there. So, all right. So we've kind of taken a look at rent versus buying. Now we're going to kind of transition into what's the housing market look like from an appreciation perspective. So we're going to take a look at LA and kind of northern Orange County a bit. And so as you can look at the appreciation rates and overall housing price index, we're up about 10%. Now, this is it as of November. So, traditionally, when we're going into November and December, the seasonality of the markets, you would say, okay, well, it's probably going to be slower in the winter months, November, December. But as you can see here in the housing price index, the market remains still red hot. So seeing still a nice climb here. Obviously, this is about 2-month-old data, but it still is going to look, even probably stronger as we look at January and then kind of headed into February. So typically your seasonal buying month or buying times of the year will be your spring and summer. Generally, that's when you have your hottest times in the market. So I think one of our questions was, hey, when's the right time to buy? Normally, if it's not a spring and summer buying time, and you're willing to purchase in the fall and winter, that can potentially be a nice time to buy because you're not competing with other households that are also looking to purchase. Some households are purchasing in the spring and summer because maybe they're transitioning school districts and they want to be in a certain location. So that's why we can kind of see more higher activity levels at that time. But we're not really in a normal market right now. So the market remains red hot, even though we're in the January and February winter months, where typically it wouldn't be as fast paced as it is today. So, the right time to buy could be now, I think, but also when the spring comes, hopefully we'll have more opportunity for our buyers because there is, like I said, pretty high demand out there. When I think back at early 2020, when we first kind of went into in this pandemic state, a lot of inventory levels slowed down because sellers just weren't willing to put their homes on the market because they just didn't know. Well, I think as we're starting to get settled in and now with the shelter in place being lifted, hopefully we're going to see more sellers that are going to be willing to put their homes on the market, create a higher level of inventory, and now buyers will have a bigger selection to choose from. Let me just let me step back for just a second. I want to talk a little bit more about just home values for a second, because I know we spent some time talking about it when we first launched in today's discussion, but what's happening in the market right now from a buyer's perspective is that because we're having such a competitive, it's just a competitive market right now, a typical home that let's say is listed at $500,000 is now getting bid up to $510,000, $515,000, maybe even $520,000 at times, sometimes even higher, because again, we have 15 to 20 potential buyers for one home. The challenge that we're having in the marketplace is even though that house gets bid up to $520,000, there's not necessarily data in the market, appraised value data that can help support that 520 value. And so the challenge comes from the lending perspective is that lenders can only lend you based upon the appraised value or purchase price, whichever is less. So when a house appraises for $500,000, but you're buying it for $520,000, the difference of $20,000 creates an issue for the buyer. And so the buyer, if you're not able to negotiate a lower price with the seller, you're going to have to come out of pocket with that $20,000. And so that's what we're seeing as being a little bit of a hurdle for buyers right now, because many sellers are saying, hey, you know what, this is the price I want for my house. And now that I have all this competitive pressure pushing my price up, I want that higher price, even though the data might not support it. And so the buyers have to be prepared to be able to potentially bring that additional money out of pocket. So that creates a little bit of dilemma for first-time buyers because maybe we don't have the resources available to be able to make up that $20,000 difference. So just something to think about as you're considering home ownership. Hopefully the market will kind of flatten out a little bit. We won't see that as much, but that's that kind of the current state that we're seeing today. Okay, so we talked a little bit about interest rates earlier and how that's driving some of the purchasing power and the demand in the markets. And as we look across, especially this slide, if you look at from March up to today, rates have continually just come down. They kind of bump around a little bit on a daily basis, but for the most part, we're seeing them kind of just drop. With new leadership of the country, we didn't know what monetary policy might look like, but all signs are pointing to pretty consistent monetary policy and trying to rejuvenate this economy. And so you're going to see rates in this level here probably for at least the next several months, and at least that's our projection. So average interest rate right now is about 2.75%. When we look back at early 2020, we saw rates in the low threes, as you can see from this chart, which is going to be, you guys are going to want to look at the blue line. That shows you what that 30-year fix has done. We didn't think we would see rates in the twos, at least until maybe early 2021. And little did we know that, before we even got to the fourth quarter of 2020, we'd already see rates drop into the twos. So we're here in this environment, at the 2.75 level, historic lows. And obviously that's creating a lot of interest in buying. for our first-time buyers, as well as for existing homeowners that have mortgages that are at 3, 4, 4.5%, and now they're considering refinancing. So there's a lot going on in the market right now that's creating that demand. So if we were to go back, a couple decades into early 90s, rates were in the double digits. Home prices were about a third of what they are today. So it looked a lot different. But, to give you some perspective, we're now talking rates that are at 0.25% of what they were back, just 2 decades ago. So really unprecedented times that we're seeing in interest rates. One question that we get a lot, and I wouldn't say a lot, but we do get this question. It's typical in our high cost of living markets. So in our Bay Area markets, LA, Orange County, and that is, would adjustable rates be better for me to lower my payment than a 30-year fixed mortgage would be? And in high interest rate environments, that answer could be yes, although I don't recommend that for first-time buyers. But in long-term low interest rate markets like we're in today, you can see on this slide that actually short-term interest rates like your 5-year fixed loans or 10-year fixed loans are actually worse or higher than 30-year fixed loans. So we would never recommend going that route because it's an inferior product, obviously, than the 30-year fixed. And really, as first-time buyers, you guys really want to be looking at a 30-year fixed because that's going to be more of a predictable payment for you. Okay. I'll take a quick pause there. Questions so far?
There was one question. It just asked, would that $20K out of pocket be in addition to the down payment?
Yeah.
Do you remember talking about that?
Okay, yeah. So I'm going to take a step back. We had a question about the $20,000 difference. So when I gave you that example about an appraisal that comes in at $500,000, the house is you're selling or buying the house for $520,000. That $20,000 would be $20,000 plus your down payment plus closing costs. So that would be the big difference. So if I'm buying the house for $520,000, I'm going to make my 3% down payment on $520,000 plus the $20,000, and then, like I said, the closing costs. Okay, that's a good question. Okay, if we need to go back and go through that again, guys, just feel free to just reach back out to us through the Q&A. Okay, let's talk a little bit about credit. I mentioned earlier that there's usually 2 things that hold people back from being able to purchase. Usually it's credit or just resources for down payment. And so let's talk a little bit about credit. And every loan program has a minimum credit score that's usually attached to it. So for FHA loans, it's usually 600. For conventional loans, it's 620. We have a program called Open Door. It's for first-time home buyers, and that has a minimum credit score of 640. And then the Cal HFA program, which we're going to spend some time going through some different scenarios with that tonight. The minimum credit score is a 660. Okay. So, and we're going to look at some of the benefits and characteristics of some of those products in just a bit, but those are the minimum credit scores that are attached to each one of those products. Now, when we look at the credit calculation, there's some different factors that are part of that FICO model. So there is 3 different models to scoring, and there's a credit card model. So when you look at your monitoring, so if you have Credit Karma or Experian or Equifax or TransUnion, they're giving you a credit card score. So that's one of the models. That's a credit card model. There's auto for auto financing. So when you go out and purchase a car, there's the auto score, and then there's a mortgage score. And that's obviously going to be used for home lending. The factors within the scoring that are going to be counted is 15% is going to be how long you've had credit, 20% how much credit you're trying to achieve, new credit you're trying to obtain, also known as inquiries. So that'll be 20% of what's built into the score. Now, inquiries come in a couple different shapes, and that is hard inquiries versus soft inquiries. A hard inquiry is going to make an impression on your credit report, and depending on how frequently you do those inquiries, could lower your credit score. Now, when you apply for a mortgage or even auto financing, once you've started the first inquiry, you have a 30-day window of time to smart shop with as many different lenders as you want, and they can do a full inquiry, and it's the equivalent of 1 credit inquiry hit to your score. Okay, so that's in a hard inquiry. A soft inquiry just gives lenders the visibility to be able to see your score. So in fact, for our pre-approval process, which we'll talk about in just a bit here, is we start with a soft inquiry. So it just gives us visibility to your Equifax score, but doesn't necessarily put an impression on your bureau. Okay, so what you really want to do is you don't want to have too many inquiries, especially for different types of products. So you don't want to have a credit card inquiry, then an auto inquiry, and then a mortgage inquiry, because then you're going to start to see your credit score drop. And then that also holds true with obtaining or opening new accounts. So if you do the inquiry and then the new account comes on your bureau, if you have too many of those accounts in a 12 to 24 month period of time, you're probably going to see your score start to pull back a little bit. Now, the biggest one we review with clients is how much I owe, but it's also known as credit utilization. So the credit utilization generally looks at the aggregate of your credit limits versus your credit balances. So ideally, if you're just trying to whittle down credit right now, you want to try to get your credit utilization below 50% of your credit limits. So if I have $10,000 in credit limits and I owe, $5,000 in credit balances, that means I have 50% utilization. So if I'm trying to get lower, I want to kind of push down that balance a little bit so I can get below 50%. So that's where I want to first kind of start. Now, if I already kind of mastered that and I'm just trying to optimize credit score, you want to try to get your utilization to below 10%. That's going to get you the biggest lift in credit score. Now, one thing that I share with clients during consultations, and it seems to be a bit of an aha, which is, I pay my credit cards off on the due date every month, but it seems that my credit balances are still showing up on my credit report. So what generally happens is the creditor, so American Express, Capital One, whoever it might be, they're going to report the credit data at the end of your billing cycle. So even if you pay off your credit balance on the due date, so let's say, for example, if I pay off my credit card on the 4th of the month, the problem is my credit card statement balance ends on the 20th. And so whatever my balance is on the 20th, that is the balance that gets reported out to the credit agencies. So even though I pay it off on the 4th, my credit report still picks up that balance of, say, $2,000 on the 20th. So the trick there is, if you're really trying to optimize credit score and show your lowest balance on your credit report, try to pay off your credit card balance before the end of your billing cycle. And that should give you the good lift. So like I try to pay off my American Express on the 20th every month so I can show that zero balance. And then on the 4th, that due date is there, but I've already paid off the balance. So I don't have to worry about it. Okay. Past challenges like bankruptcy, short sales, collections, inquiries, those are going to be the most impactful in the last 12 to 24 months on your credit bureau. I'm going to give you a little bit of a matrix to see in just a second that shows you kind of how delinquent credit, how long it's going to carry with you. Final thing on credit on this slide I want to share with you guys is account closure and how those report. It's really important that if you're moving credit cards around, and we're speaking just to revolving debt, if you close out a credit card, once you close out a credit card, that pulls away all the credit history from that account on the credit bureaus. So if I start off with a Capital One credit card that I got, let's say when I was at USC and I was on campus and I got this credit card with a $500 credit limit, and now I've been out of school 10 years and now I have a $15,000 credit limit. If I decide now to switch to a Wells Fargo Visa and cancel that Capital One credit card, what I'm doing now is I'm wiping all that great credit history out of my credit bureau. And so you want to be careful moving credit cards around because you could actually, diminish your credit score a bit. And we've seen clients that have only had 2 credit cards outstanding and they've closed them out and unfortunately have actually wiped out their entire credit score. So just be careful when you're moving or doing balance transfers and maybe eliminating a credit card. You just want to make sure you have other active credit cards that are just as long or seasoned as that credit card that you're eliminating. Okay, so I mentioned to you that we talk a little bit about or share with you this matrix on like how long delinquent items will be with you on your credit report. So credit inquiries are usually about 2 years or less. Those are hard inquiries we're speaking about. Late payments, collections, judgments, settlements, those will all be with you for 7 years on your credit report. Bankruptcies, which are going to be public records, will be on your credit report for 10 years or less. And then federal tax liens or federal student loans that are in default will stay on your credit report indefinitely. With regards to federal student loans, if they are in collection and you're thinking about home ownership, it's definitely something you want to try to get settled with the student loan provider because Federal student debt, if it's in default, they can actually prevent you from moving forward in home financing, because as a lender, we have to cross-check to make sure there is no delinquent federal debt. And there's a reporting system called CAVERS, and you'll pop up on that report if you do have federal student debt. So you want to try to settle that if you decide to move forward in home ownership. Now, one of the big topics that comes up in discussions with clients, and as a pretty familiar with our students that come to our workshops, which is student loans. And so it's important to understand how student loans can change your qualifying for a mortgage and how a lender looks at that. So there's kind of two product channels that generally first-time buyers will go with. It's either a conventional loan or an FHA loan. And I'm going to talk to you a little bit about both of those in just a second. But specific to student loans, let's talk a little bit about how a lender is going to look at those. And so most federal student loans, I think right now, are still in forbearance. If I'm not mistaken, they're an interest-free forbearance because of COVID and part of the CARES Act, which is fine. However, if you're looking to apply for a mortgage and you're still in forbearance, as a lender, we still need to count some type of payment against you for qualifying. So when you utilize a conventional loan, if you say had $100,000 in debt, we can still use the IBR payment for your qualifying. So IBR stands for income-based repayment. So if that payment is at $250 per month, that's the amount that we're going to use for qualifying. Okay, so that is on a conventional loan. Now, if your minimum payment is $0, because that's what your IBR calculation indicates, then that's the amount that we're going to use. If they're in deferment or you're in grad school, we're still going to have to count some type of payment against you. If you're in a forgiveness program because maybe you're in healthcare, there still is a minimum payment that we have to count, and hopefully it's that IBR payment. FHA loans look at it a little bit differently. FHA loans won't use the IBR payment. FHA loans will look at 1% of your outstanding balance. So instead of qualifying with the $250 payment, I actually have to take the $1,000 monthly payment and use that for the qualifying mortgage. So that can change things for clients. So it's really important that we walk you through those different options as you kind of go through your consultation. I'm going to move through the student loan piece, but we can actually come back to that if any questions come back.
Yeah, I'm sure some will pop up.
Okay, cool. Let's talk a little bit about loan programs and in terms of the different characteristics. These 5 programs are usually the most typical programs that we're going to help clients with, more so on the conventional and FHA side. So I'll kind of give you some of the basics there. And then VA, USDA, and jumbo loans, somewhat, but more so in the conventional FHA space. So let's talk a little bit about conventional loans. That has a minimum down payment of 3%. And conventional loans have different levels of loan amounts. So if you go up to loan amount in the high 500s, that's going to be what we call a conforming limit loan. Anytime you go above that amount, you're going to go into what we call as high balance. And for Orange County, LA County, you can go up to 822,375. So anytime you go over $540,000, the minimum down payment jumps from 3% to 5% when you go into the high balance space. Now, for all first-time home buyers on a conventional loan, the minimum down payment is 3%. But like I said, if you go into the higher loan range, then you have that minimum down payment jumping up to 5%. FHA loans have a minimum of 3.5% down, and they follow the same loan limits as conventional loans. That changes a little bit if you're going to buy in the Central Valley of California. So some of your Stockton, Modesto, Stanislaus County kind of areas, those FHA loan limits look a little bit different. But for the most part, in our higher cost of living areas in California, they're going to be succinct with what conventional loan limits are. Then we also have VA loans that have 0 down payment for our veterans that have served. USDA loans that also have a 0 down payment. But USDA loans are going to be for more of your kind of your rural areas, so your outlying areas. There's certain addresses that qualify under USDA. We can talk a little bit more about that offline if that's something you're interested in. And then there's jumbo loans. Those usually require a much more significant down payment. Usually it's 10 to 15%. So anytime a client is purchasing and has a loan amount that exceeds the conventional loan amount, which is $822,375, then you're going to move into a jumbo space. And that requires 10 to 15% down. the difference really between a jumbo and a conventional loan really has to come down to not just the down payment, but a thing called reserves. And I think one of our questions that came in from one of our attendees tonight, which was how much liquid cash do you need if you're going to use or take out $1 million mortgage? And so I think it'd be good to just kind of talk a little bit about that now. So the $1 million mortgage would push you into the jumbo loan category. So we would first want to understand what our down payment looks like. But jumbo loans also carry with it reserve requirements. And reserves basically says that as a consumer, I have this much in assets remaining in case something was to happen. I would have some type of financial hardships. Generally, a reserve amount is going to be 6 months of your principal, interest, taxes, insurance, and mortgage insurance. So for example, if I have a $5,000 mortgage payment, 6 months of reserves would be $30,000. So if I'm going to take out a jumbo loan, I need $30,000 in reserves, plus I need my assets for my down payment, plus my closing costs. So for our guests who had the question about the $1 million mortgage, the specific number will depend on how much you put down, and then how much the closing costs are. And of course, based upon that, how much the reserve requirement is. So we'll probably take the details of that question offline and we can kind of figure out the actual calculation. Yeah.
2 questions. Were limits removed for VA loans in 2020?
Yes, that's a good question. So the question was VA limits removed for 2020? So the answer is yes. And so all lenders are kind of integrating those loan limits as we move through. So, there's, especially when you start getting into the upper million mark, various lenders have kind of a tiered system, but yes, that is correct.
And then do we have any special programs for nurses right now? Just doctors?
Yeah. So another question came in, do we have any special programs for nurses? So unfortunately, there was no nurse specialty programs out there today. There was a down payment assistance program available through an investor that I heard about. We personally didn't offer it, but I don't think that's currently available in the market. Lending has changed quite a bit in this existing COVID environment. So many of the assistance programs that were around at one time have kind of shifted a bit. We've maintained most of those programs, but you've seen a lot of lenders kind of just make some adjustments in their product offering. Ken mentioned our medical professionals program, and I think I touched on it a little bit earlier in tonight's discussion. So a medical professionals program is in the jumbo space as well. The difference is it allows medical professionals to put as little as 5% down, and allows you to go up to a loan amount of $850,000 currently. Okay, so I know it's not much higher than the high balance amount, but for some of our other areas that might not be as high cost of living areas, that medical professionals program really pays off. We've had clients purchase, like, for example, in Corona, Corona doesn't quite have as high of maximum loan amounts. And so that medical professionals program can really help offset that, that difference in loan amount. Okay, let's talk about conventional loans versus FHA loans, because that typically is going to be one of the spaces that we're going to purchase in as first-time buyers. So you can already see there's a difference in down payment between the 3% and the 3.5%. But as it relates to mortgage insurance, there's a big difference that we want to talk through. And mortgage insurance is required by lenders if you put less than 20% down on a mortgage. Okay, so mortgage insurance will take different shapes and sizes and really cost structures, if you will, because mortgage insurance can be paid back on a monthly basis. It can be paid as what we call lender paid mortgage insurance, in terms of increasing the interest rate for a consumer. So if the average interest rate is 2.75 and I elect to take a rate, say, of 3.25%, I can potentially buy out my mortgage insurance through lender paid mortgage insurance. I can do it in a single premium, so I can just write a check to buy out my mortgage insurance. And the final option is what we call split PMI, or split mortgage insurance, where I can pay part of my mortgage insurance in an upfront premium and part of it monthly. So there's a variety of different options you can select when it comes to conventional mortgage insurance. Now, if I was to switch gears and compare that to FHA mortgage insurance has a standard premium, and that premium is usually 0.85% of the loan amount. And so they don't give you the option to change the structure of that PMI. Now, jumping back over to a conventional loan, conventional loans have different levels of premium for the mortgage insurance. And it's kind of like car insurance. And when you think about your car insurance, it's going to be based upon what your driving record looks like, what kind of car you're insuring, what your deductible looks like. All those things take into consideration for auto insurance. Conventional mortgage insurance is very similar because we're going to look at your credit score, we're going to look at your loan amount, and we're going to look at how much you're putting down. Those factors will determine how much you pay as a consumer and the premium for that mortgage insurance. So when we look at conventional versus FHA, conventional mortgage insurance based upon credit qualifying, down payment, and loan amount, FHA doesn't make a difference. Now, one of the other big differences with FHA versus conventional mortgage insurance is FHA charges monthly mortgage insurance, but they also charge upfront mortgage insurance. And that upfront mortgage insurance is 1.75% of your loan amount. It gets financed for you. However, it does add additional costs into your financing. So it's also something we want to kind of think about. And the final different characteristic, if you will, or the differentiation between conventional and FHA is around the cancellation option. Conventional loans have a mortgage insurance cancellation option. So once you have at least 2 years in your home and 22% equity, you can potentially cancel mortgage insurance for a conventional loan. However, with FHA, you have to maintain mortgage insurance for the full term of your loan. So the only way you can cancel it is essentially if you obtain a new loan through refinancing. Now, if you elect FHA and decide to put 10% down, you have to keep the mortgage insurance for 11 years, and then you'll have an automatic cancellation. But more often than not, clients that are using FHA are not going to put that significant of amount of a down payment down. Okay. So after hearing all that, you might say, well, why would I choose FHA over conventional or vice versa? Well, it just depends on qualifying because as you saw earlier in our credit slide, there's minimum credit qualifying for conventional at 620 versus FHA can be as low as 600 to 580. So there's also other important characteristics when it comes to the guidelines for each one of those programs. For example, if I've had a bankruptcy in the past, FHA only requires me to be out of that bankruptcy for 2 years, where conventional loans, I have to be out of a bankruptcy for 4 years. If I've had a foreclosure, for example, FHA says, okay, we're okay after 3 years. Conventional says we got to wait 7 years. So those differences in guidelines can be a big reason why I decided to choose one product over the other. Okay, and so that's our loan program piece. Ken, we had a question?
Yeah, can you just specify the medical professional loan, who's included in that?
Yeah, so on the medical professional program, that includes physicians, dentists, and veterinarians. And that goes up to a loan amount of $850,000. Important part of that too is on the physician's loan, student loans are not counted against the client, and the reserve requirements are not as stringent. Okay, so here's the conforming limits for 2021. So every year, right around the last week of December, Fannie Mae and Freddie Mac post the new limits based upon adjusted cost of living every year. So the limits in LA and Orange County have gone up pretty significantly. So now they're at 822, 375. It's nice to see LA County up a little bit because they were actually a little bit lower last year as opposed to Orange County. So they're a little bit more in line with each other. And then Riverside, San Bernardino, Ventura, San Diego, a bit lower. I mentioned to you earlier about maybe jumbo loans out in the kind of the Corona area. That's where we're seeing maybe an opportunity where we're seeing a little bit more of a higher cost of living out in those areas, but necessarily the loan limits aren't quite reflective of that at this point. Okay, I'm going to spend just a few minutes talking to you about qualifying income because as we're kind of building our scenario for home buying, we also got to look at verifiable income for us because that's what a lender is going to look for when it comes to qualifying us. So there's a few pieces of documentation that's going to be requested of you as a W-2 wage earner. So if I'm an employee working for an employer, I'm generally going to need the last 2 years of W-2s, last 30 days of pay stubs. And at some point, that lender is going to do a verification of employment. That's going to probably be a written and a verbal verification. Unfortunately, with unemployment rates being where they're at, there is multiple verifications that happen with employment because employment unfortunately changes quite often for clients. So that's pretty easy on the W-2 wage earner side. Self-employed, it gets a little bit more challenging, or not necessarily challenging, but we're going to ask for a little bit more documentation. So usually we'll want the last 2 years of taxes for the business. If you're a sole proprietor, your last 2 years of individual or personal tax returns are sufficient. And then we'll usually need a profit and loss statement and a balance sheet. And then the final thing usually they'll ask for is some type of verification of the business, whether it's a business license or maybe a CPA letter to verify the business. Okay. Depending if you're an S Corp, C Corp, LLC, we'll ask for certain things. Generally, if you own more than 20% of a business, they're going to want to see the last 2 years of taxes for that particular business. Now, if I have W-2 wages and I also have a side business, if I've been doing that side business, let's say I'm doing driving for Uber or Lyft or whatever, that's considered self-employment income. If you want to use that for your qualifying of your mortgage, then we have to produce the last 2 years of taxes to validate that information. Just a couple just side notes for you. If you're working 2 jobs right now, to have both jobs considered for qualifying, you do have to be able to show that you've been working 2 jobs consistently for the last 2 years. So that's usually a requirement for lenders. Now, the other big question we get, and it's kind of a misconception, if you will, a lot of clients will come to us and say, Jason, I haven't been on my job 2 years, so I don't think I can qualify for a mortgage, and which actually isn't the case. The key with qualifying for a mortgage is you have to show that you've had education or work history for the last 2 years. So for example, if I went to school and I got my accounting degree and now I'm getting ready to start a job in the spring at an accounting firm, even though I haven't been on my job for 2 years, I'm just getting ready to start it, you can still qualify for a mortgage with an offer letter and showing proof of your education at USC and graduating in accounting. That would satisfy that 2-year requirement. Okay, so this is an important thing to know because a lot of people kind of just hold back in home buying because they think they got to wait till they're on the job for 2 years. Same thing holds true if I've been working on a particular or in a position for say 1 year and then I get a job offer and I go to another employer. As long as I can show that I've got an executed offer letter, that new income can potentially be used for the qualifying of the mortgage. All right. Okay, so one thing that lenders will look at for you when it comes to figuring out your financing for your mortgage is a calculation called debt to income ratio. And it's pretty simple. It takes a look at your gross monthly income versus your expenses. And, when we look at that calculation, it's a good barometer for qualifying, but it's not necessarily a good factor when it comes to affordability. And so when we sit down with clients over a video consultation and we kind of figure out what their budget looks like, we're looking at affordability and kind of understanding what that mortgage payment really needs to be versus what you need to have that to qualify. But nonetheless, lenders will look at a thing called debt to income ratio, and that usually needs to be anywhere between 43 to 45%. So that debt to income ratio takes into consideration all of my debts that show up on my credit report, plus my new expected housing expense. So for example, on this slide, I'm looking at principal and interest, taxes, insurance, PMI, maybe HOA dues. If the sum of that is $2,500 a month, plus I have outgoing debts of like $500 a month, then my expenses are $3,000. If I look at my gross monthly income, it's $8,500. Then my debt to income ratio is about 35.29%. Okay, so that's what a lender is going to look at. And the highest it should be is 45%. In working with as many first-time home buyers as I do, usually we want to see that number around 33 to 36%. And that usually indicates pretty good affordability. Now, everyone that we meet with has a different level of affordability, and that's something we're going to talk through as part of your consultation. I'm gonna keep it moving here. How are we doing on time check here? Are we okay on
7?
Okay, so we'll move through a few of these slides here relatively quickly, and then we'll start getting into some of the nuts and bolts of the process here. Down payment. This slide's going to kind of highlight for you some of the acceptable sources of down payment. Just some takeaways on this slide should be that you can't use cash in a real estate transaction, so everything has to be paper trailed when it comes to utilizing in a real estate transaction. Potentially 401ks, 403bs, even IRAs can be used for assets. A footnote for IRAs, though, you want to check with your tax advisor because that could create a tax event. So you want to make sure that that doesn't create a challenge there for you. And then gift funds can be used for a home purchase, and they don't require any type of seasoning. Most assets require 60 days of seasoning, but with gift funds, a family member can gift it to you right away, and it can be used for your home purchase. There's a way that we have to paper trail gift funds. It's usually in the form of a gift letter, proof of the asset statement, and then some type of proof of transfer like a wire receipt. Okay, let's move into the first-time homebuyer portion when it comes to assistance. Again, usually assets with credit and assets usually are part of the two challenges for first-time homebuyers. So I work with Cal HFA, which is the California Housing Finance Agency, and this agency is designed to help low to moderate income households in California. And what we do is we partner with Cal HFA to help design financing options for first-time homebuyers. So I love to share this as part of our workshops that we teach because it can make homeownership that much more within reach for you. And so there's a couple different assistance programs that can be combined with conventional loans and FHA loans. The first one is the My Home product. It allows you to borrow up to 3 or 3.5% of your sales price, depending on which product you're looking at. So if it's a conventional loan, it's 3%. FHA is 3.5%, and it has a maximum down payment of $10,000. However, if you're a public school employee, like a teacher or a school counselor, fire department employee, or if you're buying a new home, then there is no maximum on that $10,000. So if you're buying a $600,000 house, you would get the full 3%, which would be $18,000 towards your home purchase. Like I mentioned, you're borrowing this from the state, so it is a low interest loan. It's 2% simple interest. And the cool thing about it is you're not required to repay that money until you either sell or if you refinance in the future. So that's called the My Home Down Payment and Assistance Program. The other program available to you is called the ZIP program. It's for closing costs. So when you purchase a home, you usually have closing costs, which are 2 to 3% of your sales price. The ZIP assistance is interest-free assistance of, again, up to 2 to 3% of your loan amount. And you're also not required to pay that back until you either sell or refinance in the future. Here's a quick example of how the assistance program works. So, and I'll just kind of give you a high-level look at it. So when you're purchasing a home, let's say you have like $500,000 in sales price, usually you're going to need about $25,000 to $30,000 out of pocket. Okay, so that's what you should expect. Now, if you were to buy that same $500,000 house with Cal HFA assistance, you can still get a conventional loan, but in this case, now you're getting $19,800 to $24,700 in assistance, and that can be used to help offset this expected cash to close figure. So as you can see, now the asset levels that are required they change quite a bit when you use an assistance program like this. Now, rates can vary on the assistance program. So today's rates on the Cal HFA program range from 2.875 up to 3.25%. So they're not too far off the market rates. And obviously that provides a huge opportunity when it comes to the asset support that you can get for purchasing your home. Okay, so again, that's called the Cal HFA assistance program. Eligibility for this program, it does require a 660 credit score. Your maximum debt to income ratio is 45%. They only look at the applicant's income, and why that's important is because there is maximum income limits based upon the county that you're purchasing in. So for example, if I'm going to buy in LA County, my income cannot exceed $153,000. So if I was to purchase on my own and I make $100,000 and my spouse makes $80,000, my household income is $180,000. However, if I just apply for the mortgage, then we just look at my $100,000 income. And so technically I would qualify in LA County for assistance. And a first-time homebuyer on this program is anyone that hasn't owned in the last 3 years. So potentially if I've owned back in, let's say 2010 and I sold that house, now as long as I've rented for the last 3 years, I'm still considered a first-time buyer. Here's those income limits I just referred to. So LA County is 153,000, Orange is 203. You can see Riverside 149. So normally most first-time buyer programs are going to be capped at 80% of the median income for a community. So when we look at the Cal HFA program, it's serving more the low to moderate income in California. So it really provides a huge benefit. It's more kind of an all-inclusive type program, because when we look at, let's say, for example, in Sacramento, the median income or 80% of the median income is like 68,000 here. In some parts of LA, it's like 62,000. So you just can't help as many clients in the community. So when you get connected with a product like Cali Chebe, it can really help serve a much larger audience. Okay, we're gonna kind of transition over into the loan process side. And this is our 6 steps of home buying. So I think this will be really informational for our first-time home buyers, so you can really understand kind of what comes next when it comes to purchasing a home. So the first step in this process is to get pre-approved. And, it's something that, we take a lot of pride in, because we look at this as the output of a consultation with you. And a pre-approval is a certificate that says that you're qualified for your mortgage, and that certificate is used to be presented to a seller. Like I mentioned, this is the output of a consultation with us, and a consultation allows us to go over video with you, kind of design a home budget for you, figure out what the right financing solution is for you, talk a little bit about interest rate, payments, out-of-pocket expense, walk through the 6 steps of home buying, and then like the output of that is a pre-approval certificate. Some lenders will issue pre-qualifications, and the difference between a pre-approval and a pre-qualification is a pre-approval reviews your income, assets, and credit and program. A pre-qualification simply just takes your application and looks at your credit and determines eligibility. So especially in a competitive market right now like this, we really recommend a pre-approval. We don't even offer pre-qualifications because it just can't stand up in the marketplace today. So that's the pre-approval. Now, after you've been pre-approved, then you generally move into the house hunting. Now, some of you on this line today might even already start the house hunting. You haven't been pre-approved, and that's pretty typical. Most clients are going to look on Zillow or Redfin or Trulia and find a house that they really love and then try to figure out home financing. But ideally, we want to get pre-approved, then go find the right house. So with house hunting, you're going to work with a realtor. And a realtor generally will kind of take all the characteristics that you're looking for in a community and try to find a list of homes that are available to you. Now, if you decide on a few homes that, that really kind of fit the idea that you have in home ownership, then you're going to go view those properties. Now, if you decide to make an offer on the property, the realtor will help design that offer and the terms and conditions, and then present that offer to a listing agent. And then they will start the negotiating back and forth. Now, if the seller accepts your offer and decides to go forward with you, then you're going to move to step 3, which is called entering escrow. And the escrow time period is usually 30 days. So if the time at which you have an offer that gets accepted to the time at which you get your keys, it's usually about 30 days. Now, at the inception of the contract, you're going to be required as a buyer to make an earnest money deposit, and that's usually 1% to 2% of your sales price. That money goes towards your total out-of-pocket expense, but is a deposit that's held in escrow while we're starting this 30-day time period. Now, within 2 to 3 days after you've gone into escrow, you're going to reconnect with us for what we call a follow-up consultation. That allows us to kind of reaffirm the financing structure for you, go through the specific terms and conditions of your loan, and make sure you guys have a good roadmap for how we're going to get from step 3 all the way to step 6. Okay. Now, when we start that escrow time period, it also begins what we call as the contingency period. And in California real estate, you'll generally have a contingency, and usually it's 14 to 21 days of the contract of the escrow time period. That allows you as a buyer to do your due diligence on the property to make sure this is truly what you're expecting. So you're going to get the house appraised, like we talked about earlier in tonight's discussion. You want to make sure the house is worth what you're paying for. You're going to get the house inspected, and you're going to get your loan approved. And that usually happens in the first 14 to 21 days of your contract period. So usually that contingency period will take you all the way up to step 5. Now, while you're in contingency, your deposit is completely protected. So you as a buyer can feel safe that, you want to do your due diligence and then decide to go forward in the process. Now, once you've agreed that you're satisfied with all the outcome of those reports, you're going to sign off on your contingency. Once you've signed off on contingency, then you're kind of all in on the transaction. So if you decide to cancel a couple of days later after signing off on your contingency, then you could forfeit your deposit. So you really want to work tightly with your realtor to make sure that you feel comfortable moving forward and there's no kind of second guessing, because you've kind of pushed forward and now the seller knows that you want to continue in the transaction. Now, at every one of these milestones that we have here, milestone 3, 4, and 5, you as a buyer will be getting disclosures sent to you. Generally, they're e-signature disclosures. They highlight your interest rate, your payment, your out-of-pocket expense. And so there's really no surprises along the way. So you know exactly kind of how your financing is designed. Once you get to step 5 and you have your loan approved and you remove contingency, as a lender, we're going to deliver to you a final closing disclosure. And that usually gives you a 3-day cooling off period before we can move to the final stage, which is step 6. And that's called closing the loan. Closing the loan is still a little bit old school, if you will, because all the disclosures done at the closing stage have to be done via wet signature, and they have to be done in front of a public notary. So in this COVID environment today, all signings are done outdoors with a notary that is masked and gloves and everything. So it's a completely safe environment, but we still do signatures in person for the closing of the loan stage. So at step 6, you're going to go ahead and sign final documents. And if there's any remaining funds that you need to contribute to the transaction as a buyer, you'll make that final deposit. That's usually via wire or a cashier's check. So it has to be certified funds. After those funds have been collected by the escrow company, then they'll make sure that you've made your fair contribution according to your contract. And then as the lender, we're going to do one more final audit. And then once that audit is complete, we're going to wire in the mortgage funds to the escrow company. The escrow company will make sure everything's within balance, and then they're going to transfer documents to the county that you're buying in, the county recorder's office that you're buying in. And they will record a grant deed to transfer ownership to you. And then they're going to record a deed of trust, which is a security agreement that is the agreement you're going to repay the loan that you're providing. And once that's all occurred, then you become the official owner of the property. So lots of little details in that whole process here, but that's kind of a high 10,000-foot view of the loan process. Now, I mentioned to you a little bit about the consultation. I think that's really an important part as a next step after these workshops. If you're not ready quite for a consultation, I'd love to connect with everybody for just an intro call, just to kind of hear where you're at, where you want to go with homeownership, answer any follow-up questions. And that's like usually a 5 to 15-minute call that we can have with some of our guests from the workshop. If you're ready to get going and you want to kind of just really build that homeownership game plan, I really encourage our guests to go and book a consultation with us. And that consultation allows us to formulate that budget for you, understand more about the 6 steps of home buying, and really get everything designed so you can confidently go out in the market and decide to take that next steps in homeownership. We try to do those consultations over video so we can screen share with you and show you what the different interest rate options look like, the payments, the out-of-pocket expense. And those are usually about 30 to 60 minutes. Okay. So if you want to book one of those calls with us, you can just click here in the schedule an appointment, and we can certainly get connected with you and get that all figured out. Just as a side note, the consultations are absolutely free. So it's not something we charge. It's just something we want to help educate you. We get that this is probably the largest investment that you're going to make in your lifetime. So we really want to keep you informed and make you understand kind of the next steps in getting towards home ownership. Again, I mentioned this consultation is going to include looking at your housing situation, setting some goals for yourself, looking at affordability, finding out where do you want to buy, and then I'll kind of walk you through the application process, and we'll wrap up with that pre-approval certificate and really the benefits of partnering with a preferred realtor. Now, as you know, and being part of the Young Alumni with USC, we have a discount program set up for USC alumni. It's a discount program on closing costs that helps kind of make homeownership that much more inexpensive for you. And so we'll kind of walk through that also as part of your consultation. We have our full array of products available to our USC family, and including our secured lock program that allow you to lock an interest rate even before you've found that home. And so we can talk through that a little bit more. We're a trusted mortgage provider, so we really understand this is going to be a big commitment for you. So we really want to be there every step of the way. So we try to really make this a high-touch experience for you as you're going through just this journey of home ownership. We have some great tools that are available to you. One of them is our mobile app. You can download it for Android or Apple. It'll allow you to track the progress of your loan as you go through that 6 steps of home buying. It has some really cool calculators. So as you're out home shopping, you can do some calculations and figure out what payments look like. And just a way of just kind of you better staying connected with us as you kind of move through that process. Here's all my contact information. I love hearing from our clients, especially our guests at these workshops. So if you have follow-up questions, feel free to text me. I have my cell phone number here included. You have your own dedicated landing page. So it's Go Trojans Mortgage. You can check out some of our calculators there, some of the benefits for the USC family, and kind of the next steps in home ownership, as well as some of our programs. Also got my email address here too for you. We love what our clients are saying about us, especially some of our graduates from our workshops. And so check us out on some of our social channels, a lot of cool testimonials out there. In fact, a lot of graduates, if you will, from our workshops that have kind of shared their stories about what it means for them to go through the home ownership process, and really what a huge achievement it is for them in their next steps in life. So with that said, I know I kind of ran through those last slides pretty quickly. We're trying to do some Q&A. I guess we're gonna hang out for some Q&A and answer any questions and kind of do some follow-up here from tonight's discussion. Again, you're gonna get tonight's deck page via email. And so you'll get all this material for your reference. And like I said, if you wanna connect with us after tonight's call, feel free to set up an intro call for us, or with us, I should say, or we'd love to be able to also connect with you for a consultation, okay? So Marissa, I don't know if you're still there with us, but we'll keep the lines open here for our consultation, or not consultation, but for our Q&A here, and pick up any questions that our audience has.
I have a couple.
Okay,
that
cool.
were from before.
Okay.
Do you have any insight on Prop 19 or inheritance in terms of trying to buy a property?
So the question was insight around Prop 19 and any inheritance. I'm going to defer that to a tax advisor, just because that's kind of an important piece and could have some tax implications. But I would encourage you to talk to a tax advisor about that. It's probably the best resource for you. And kind of taking that one step further as it relates to kind of just taking the next steps in homeownership. If you're working currently with a financial advisor, I would also loop in your financial advisor about what you're looking to do for your home purchase, and that's of a benefit for you. I want to make sure I got one question that came before tonight's workshop, which was how should I approach down payment, i.e. how much should I have saved? So I think I hopefully hit on that tonight. And really that question will be answered based upon what your sales price is going to be. And so there really isn't a magic number other than a minimum amount based upon your sales price. And I think really once we sit down and connect with you and understand what your budget is going to be, then we can kind of figure out what the right sales price is and then the corresponding down payment. So I hope I hit most of the questions that came in advance, and then it sounds like we got a couple more coming in.
Let's see, tenants in common properties. Do we do loans for those or?
Yeah, so a question came in about tenants in common. So those are case by case because they do at times have some deed restrictions to them. So that's a question we'd want to take offline to look at the specific property, because in some cases we can finance a tenants in common.
At what point in the process does the lender do a hard pull on your credit?
So the question was, when in the process does the lender do a hard inquiry? So it really depends on the lender. Most lenders are going to do a hard inquiry right from initial application. We take a little bit of a different approach. We'll do a soft inquiry just so we can have that conversation about where you're at from a debt perspective and credit score. If we need to do kind of more of a deeper dive and help you better understand your credit, we may recommend doing a hard inquiry. But our first initial consultation will start with just a soft inquiry.
Let's see, pros and cons of buying land and building on it versus buying a property and renovating it.
Okay, so good question. So pros and cons of buying land and constructing a property versus buying a house and renovating. So it really depends on how creative and patient you are, I guess, really, right? With constructing a house from a financing perspective can be a little bit more challenging, especially in this lending environment right now. There really isn't a lot of construction loan resources out there. So when you do construction, you have to acquire the land and then you have to get financing to build the property. So that's where there's a little bit of a disconnect right now with just financing opportunities. When it comes to renovation, There is products available that allow you to purchase maybe a distressed property from a condition standpoint and be able to renovate the property. There's a couple different products offered through Fannie Mae and Freddie Mac. It's called the Dream Renovation, I believe. And then there's FHA also has a 203K loan that allows you also to use funds to renovate a property. So if you're a first-time buyer, that's a project that you'd be taking on, but nonetheless, there is financing options available to you. So it really just depends on what your financial goals are and, like I said, how patient you are in that process.
I know this is more of a realtor question, but you might still have some insight. Okay. Any tips on how to make your offer more competitive and appealing to a seller?
Yeah, so question was, how do you make your offer a little bit more appealing to a seller? So that depends. A realtor is probably going to better answer that, but I'll give you my 2 cents because I work in partnership with the realtors in terms of they have some requests of me in terms of what they need to make their offer more attractive. So we talk about contingency periods. So that 14 to 21 day contingency period. Some realtors are shortening those contingency periods. So instead of 14 days, maybe it's 10 days. Maybe they're doing shorter timelines on their inspections. In some cases, some sellers are asking buyers to waive their appraisal contingency. I'm not necessarily a fan of that, but that's something that it's kind of a case by case based upon the buyer's resources, because you could create a little bit of a dilemma for yourself if that appraisal is sufficient or significantly short of the purchase price. That's what we kind of are seeing in the market. I think, shorter contingency periods, they're also looking for shorter close of escrow time periods. Ultimately, sellers are looking for just security in the transaction. That's kind of what, that's what you're going to have to do to make your offer stand out.
Let's see. Do we do loans for a prefab home on land?
Okay, so the question was, do we do loans for prefab home on land? So I think, prefab, but also in my book would be a manufactured home. As long as it's on land that's owned, the answer is yes. We have to understand kind of better what the land looks like in terms of make sure that it's owned land and, it's affixed to the property, but the property is affixed to the land. A question that we get in some cases is, can I buy a mobile home or a manufactured home on leased land? And the answer is no. Manufactured and mobile homes on leased land are considered personal property and not eligible for traditional financing. There is lenders that are available out there that will do that type of financing. I'm not aware of them or haven't know of any in particular, but you can certainly search that. I think there's some out that are available out there.
Any thoughts on buying through a county auction?
So a question came in about any thoughts around buying through a county auction. I think if you have the resources to do that, could be a good opportunity, but buying through a county auction, you're generally gonna have to buy the property in cash, as far as I know. So that's a little bit of a different, and you're gonna be competing with companies that do that as a business model. So, that's something you want to just kind of keep in mind. These are great questions. You guys are giving some good.
Here's one that might be good. If they're interested in buying the condo they're renting, would you need an independent appraisal and inspection? And is it the same sales process? Okay, so another question that came in, if I'm looking at buying the property, this happened to be a condo that they're looking at purchasing. If I'm gonna buy the condo or single family residence that I'm living in right now from my landlord, would I still need my inspections and whatnot? So from a lending perspective, you'll still need to get an appraisal done and you'll still need to draft a purchase contract. It will be up to you if you decide you want to do inspections on the property. So you'll just have to put that together. Now, many landlords that are looking to sell to their tenants right now are trying to eliminate the fees incurred by using a realtor. That's, why they're possibly trying to sell it to the tenant. So you just want to make sure you cover your bases in that. I always encourage clients to maybe just consult with a realtor just to make sure that you're getting a fair deal, of course, but also making sure that you're drafting an agreement that is compliant. Okay, maybe we'll take maybe one or two more. And let's see, your thoughts on what will happen to the market once COVID-related moratoriums are lifted?
Okay. So it'll be interesting. I think let me tell you what the question was. The question is what will the housing market look like after the COVID moratorium periods are lifted? We'll see what happens in the market. I mean, I think that kind of goes to the point earlier about the long-term effect in the market. We're still kind of unclear what it's going to look like. I mean, if we have distressed sales in the market, that's obviously going to change the complexion of the market drastically. Well, I hope we don't get to that point, but at least at this point, the market remains super strong. And we're projecting, I didn't mention this earlier, but we're projecting 2021 housing buying or home buying market to be stronger than it was in 2020. Now we need more inventory to fuel that, but ultimately the early projections are this is going to be even a bigger year for 2021.
Any math or recommendation about how much you should have in your savings when purchasing a home?
Yeah, that's a good question. So the question came in, what should be the savings in your account when you're thinking about purchasing a home? So that depends for every buyer's a little bit different. I think as a rule of thumb, you should generally probably have 3 to 6 months worth of your mortgage payments saved after you distribute your down payment and closing costs. So the overall assets that you would need really just depends on the purchase price of your home. So if we did the quick math, if you bought a $500,000 house, you're going to need at least $15,000. Closing costs, maybe another $10,000. So now I'm at $25,000. And if I'm looking at maybe another 3 months of reserves, maybe it's another $9,000 on top of that. So maybe $34,000 or so. So again, everybody's situation is going to be a little bit different. Every client has different comfort levels and affordability levels. And so I think that's where you're going to kind of really want to have that discussion as part of a consultation. Good. We're good. Awesome questions from the audience. Thank you so much for participating. I really appreciate that interaction. That makes a really fun workshop. I appreciate the USC Young Alumni for allowing me to speak to you this evening. We've had a wonderful participation with you guys. Again, if you have any questions that maybe just didn't get answered tonight, feel free to reach out to myself or Ken. We'd love to be able to get those answers back to you. We're hoping that we get to connect with you soon. If you have anything else for us, please let us know. Have a wonderful evening, and we'll talk to you soon.